Coming up on the program today, International Monetary Fund approves about $80 million emergency fund to Burkina Faso. The African Development Bank approves $28.49 million grant to enhance Ghana's universal electrification goal. Kenya and Germany to remove non-tariff barriers to boost trade. Hello and welcome to another edition of Business Incorporated. I'm Will Ibang, and as always, we dive into the markets and starting with Africa, where sentiments were mostly positive. At intraday, we saw Nigeria's NGX trading marginally down 0.01%, as you know, coming off from yesterday's bearish close at intraday. We also saw JSE in the South Africa. The biggest gainer today was up more than 1%. Elsewhere, we saw Egypt still, trading very, very in the green today, 0.14%, while Kenya closed yesterday's session up by 0.81%. Now we're going to dive into the NGX and see what's moving the market what's moving the market today, what's driving investor sentiment. So we're going to be talking to Mohammed Kayode. He is the stockbroker APT Securities Limited. Good afternoon, Kayode. It's good to have you on the program.
Good afternoon. It's a pleasure to be here on the program.
Now, we've seen, just before we came into the program, saw that MTN has marked down their share price. The equity price of MTN has been adjusted today for dividend payout of 10 naira, as recommended by the company's board. So now it's opened at 233 naira. That's what it closed at yesterday, but currently trading at 223 naira. How is this going to affect investor sentiment going forward?
Thank you very much. As you have known, that the market is, our ASI is structured around the big cap stock. It's a weighted index stock. So it's a value index stock. So it's a value index index. So for that reason, it's going to push down the ASI, the general performance in the market, down. So the investor sentiment right now in the market is still positive. As we speak today, as we speak now, we are having 0.2%. Market is gaining 0.2%. So the result from the MTN, as we have witnessed so far, the result has been released into the market. The listed company have performed wonderfully well in the audited account that has been submitted so far. So we are witnessing a kind of situation whereby the market is too quiet for now because of the fact that most of those listed companies, especially the banking sector, have yet to release their results, with the exception of Stanbic IBTC, who has released his results. But other listed companies from banking sector are yet to release their results. And this is making the market to a kind of a slow activities in the market. But despite that, we still believe that whenever they release their audited report, the market will still going to react it's going to react in a positive way to the market generally. So we are having another issue on ground. The cash crunch that we have at the beginning of the year is going to likely affect the first quarter result. And immediately that this listed company have started releasing their first quarter results, you realize that there is going to be a kind of decrease in their performance. The performance may not be good. So as we speak for now, we believe that investors' sentiment about the market is still positive, but there is going to be a kind of short reaction to those results that has been released for the first quarter.
So you're talking about investor sentiments being still in positive territory, but we saw yesterday's sentiment report showing that the NGX all-share index buy was at 0%. So I don't think that speaks to positivity. And what would you say, what should we expect for the banking sectors, the banks that have not released their earnings? What should we expect from them?
Thank you. What you have just said right now is a very, you are right. But what I'm saying here is that investor sentiment is generally measured by ASI. And this ASI is being controlled by ICAP stock. Yesterday, we have a situation whereby Airtel alone lost almost 10%, 9 point something percent. MTN also lost about 2 point something percent yesterday. And these are heavyweight champions in the market. Whenever you see these two stocks close in the red, the market must definitely close in that magnitude, and that's exactly what we have. But to say the investment sentiment, the investor sentiment, you look at what we traded today. We traded more than 4 billion worth of stock yesterday, which is a kind of more than 20-something percent or more than 27% of what we used to trade in the market. But leaving that aside, going into banking sector, as I've said earlier, that they are yet to release their results. The banking sector are yet to release their results. So we are waiting for them. We believe that whatever they are going to release is going to be good because of the fact that the activities in the last year was very good. And even when you look at what the result from GDP growth, it means there's increased productivity during the year. So we should expect that this result, the result of this listed banking stock will be good for the audited report. But going to the first quarter result is what we are having issue with because of the cash record that we have earlier in the year.
Okay, so just one word. Just tell me, what do you think the market will lean towards, positive or negative today?
The market should close in the positive territory.
Okay, thank you so much, Mohammed Kayode, stockbroker, APT Securities Limited, for sharing your thoughts on the program.
Thank you. It's a pleasure to be here with you. Thank you.
So now over to the Middle East, where we saw mixed sentiments at intraday. The Abu Dhabi was up, was positive today, rather. Abu Dhabi was up 0.22%, Dubai up 1.64%, and still within the region, we saw Saudi Arabia up 0.04%, and the Qatari index up, the biggest gainer, 2.05%. Now we move over to the EU, where the EU and Germany have agreed to ban the sale of fossil fuel cars from 2035 after offering concessions to Germany, as I mentioned earlier. Now, Berlin had previously blocked the plans under pressure from its powerful car industry. But for more on that, let's bring in Kate Ferguson from Deutsche Welle in Berlin. Kate, what has been agreed now?
Well, this is a bit of a fudge, really. The original plans involved a blanket ban of combustion engines in new cars. Why? Well, because conventionally, combustion engines involve burning diesel or gas, and they are, of course, a major source of CO2 emissions. Member states had all but agreed to this, but Germany in the last moment lodged an objection, and that forced countries to return to the drawing board. What has now been agreed is that combustion engines that burn low-carbon synthetic fuels will be allowed. Now, these fuels are also known as e-fuels, and they're produced using electricity from renewable hydrogen. But the technology is still in the really early stages of development. This is, of course, a welcome move for German car giants like Porsche, which had been lobbying hard against a blanket ban. It's also good, as you'd expect, for makers of combustion engines. The terms of the compromise do state that these engines must be fixed with technology that would be able to detect if fossil fuels were being used instead of cleaner alternatives. But critics point out that this would still be easy to manipulate and that it leaves open the door to another scandal like Dieselgate. Opponents also say that it will leave the EU at a competitive disadvantage as it will lessen the urgency to manufacture electric vehicles at speed.
So what exactly will happen in 2035 then?
Well, first of all, the reason that 2035 has been chosen is that the average life cycle of a car is 15 years, and the EU has the target of becoming carbon neutral by 2050. So from that year on, you will not be able to buy a new car that burns fossil fuels. Of course, if you have an existing car with a combustion engine, you'll be able to use it for as long as you like, but the cost of maintaining it is likely to increase. This also applies to second-hand cars that run on diesel and gas. The aim is that by 2035, cars run on electric batteries will be the norm, and competition within the sector will have driven prices right down. That said, though, this new compromise has extended the lifespan of the combustion engine, and it may make people less inclined to move to fully electric vehicles. Getting policy right on this is really critical. The transport sector accounts for over a quarter of the EU's CO2 emissions, and addressing that, as we've seen, is a really delicate balancing act, and it involves many competing interests.
So what's on the investors' mind today?
Well, investors are still trying to suss out whether they can really afford to breathe a sigh of relief after the banking turmoil of the past few weeks. They've been drawing comfort from the news that First Citizens Bank would be acquiring Silicon Valley Bank's deposits and loans. Shares in Deutsche Bank began the week by recovering much of the losses of last, but of course we are always only one interest rate decision away from major market jitters, so the sector certainly isn't out of the woods yet. In terms of big gains though, Swiss drug maker Novartis stands out. Shares rose well over 7% on Monday after positive news about its breast cancer drug. We'll see if those gains hold steady for the rest of the week. A key German survey of business confidence also showed that industry leaders are feeling more optimistic, especially due to an uptick in manufacturing and the services sector. So a couple of bright spots, even if caution remains.
Thanks so much, Kate Ferguson, for sharing your update with us. Now move on to Asia, where trades were mixed on Tuesday after Wall Street saw eased investor fears of contagion from the recent banking turmoil after First Citizens Bank shares agreed to buy large parts of Silicon Valley Bank. Hong Kong's Hang Seng Index was up 0.94% and the Hang Seng Tech Index gained 0.7%. In Australia, we saw the S&P ASX 200 close 1.04% up at intraday, at the close of the bell. Now, banks were largely traded higher, and retail sales in February rose 6.4% when compared to a year ago. Meanwhile, Japan's Nikkei 225 climbed 0.15% to close at 27,518 points. South Korea's Kospi rose 1.07% to finish at 2,434 points as investors further digested economic data from the region. Mainland Chinese markets were the outlier in the region as the Shanghai Composite closed 0.19% lower at the close of the bell, and the Shenzhen component shed 0.72% to end at 11,564 points. Now in the U.S., stock futures fell on Tuesday after rising earlier, and this is despite ease in banking sector concerns. Shares of Lyft gained after hours as the ride-sharing company announced a new CEO. Futures tied to the Dow Jones and Industrial Average fell 0.04%. Meanwhile, S&P 500 and Nasdaq 100 futures dropped 0.13% and 0.24% each. The overnight moves follow a mixed session on Monday. Investors fought to extend last week's gains, but tech shares came under pressure. Meanwhile, a slew of positive news reports helped lift sentiments on Wall Street, including First Citizens Bank shares agreement to buy large parts of Silicon Valley Bank. Now, after the break, commodities market update. That's right after the break. This is Business Incorporated. Welcome back. Now we're going to be looking at copper. Copper prices have reached an all-time high of $10,845 per ton in March 2022, and following Russia's invasion of Ukraine, but fell to $8,386.25 per ton in the latter half of the year. However, copper prices have rallied by 6.44% to $8,926 per ton this year. But what does this rally in copper prices mean for the balance of economic power in the African region. We have Adeye Adegbusi, analyst, financial derivatives company, to discuss this with me. Good afternoon, Adeye. It's good to have you on the program. So what does this mean, this rise in prices in copper? What does this mean for Africa?
Well, firstly, copper prices rose to all-time highs in 2022 due to global supply disruptions following Russia's invasion of Ukraine, as Russia is the seventh largest producer of copper in the world. But later during the second half of the year, it fell due to global monetary tightening policies, rising inflation, and resurgence of COVID cases in China, as China is the largest consumer of copper in the world. This year, there has been a rally in prices as China has reopened its economy and due to the increased importance of the switch to renewable energy. Now, Africa is one of the largest, most important hotspots for copper production in the world. Production is mainly done in countries like Democratic Republic of Congo, DRC, Zambia, South Africa, and countries like Namibia and Botswana are emerging as new hotspots for the minerals exploration. So rising prices has stoked interest in Africa's mining operations. Last year, the US signed a memorandum of understanding with Zambia and DRC to produce a supply chain of EV batteries. Also, the cobalt metals, they plan to invest $150 million into Zambia's copper mining operations. Now, countries like Zambia and DRC, they are well positioned to benefit from rising demands as they have high copper deposits. Copper exports account for 56% and 80% of DRC and Zambia's export earnings, respectively. Now, this gives them an opportunity to benefit from rising demand, since it will improve profits, improve revenues, and it will power inclusive growth, which could lead to a shift in economic power in Africa, especially sub-Saharan Africa.
Well, seeing that the Economist Intelligence Unit, that's the EIU, is projecting global copper production to expand by 4.4% in 2023. And this is as raw materials availability. This is because of, there's a lot of raw materials, and there's a shift now to cleaner energy, which will support, production growth. However, we're seeing global production of this commodity, this copper, is still expected to fall short of demand, and this is, going to, put pressure more on demand, and this is going to widen the gap even further. Are there solutions to this problem, or would we see the shift? Would the shift to renewable energy prove unrealistic in the near future?
As you said, EIU forecasts a 4.4% increase in copper production this year, because as rising prices have incentivized producers to expand production in operating mines and restart production in mines that have not been operating for a while. Now, there are new mining operations, explorations going on in DRC, Zambia, and Mongolia, which is expected to boost production this year. But the EIU forecasts demand for copper to total 26.08 million tons, while supply will just be 22.60 million tons this year, creating a deficit of around 3.5 million tons. This is expected to put upward pressure on prices. Also, demand for copper is expected to reach 50 million by 2030 due to its increased importance in the switch to renewable energies and its use in production of EV batteries. So copper is a very important component in solar thermal heating and cooling systems due to its high heat conductivity and resistance to atmospheric and water corrosion. So there is no easy solution to boosting copper supply, as it takes a long time for mines to develop. A study by the International Energy Agency noted that it takes about 17 years for a copper mine to go from discovery to production. So this might stifle the switch to renewable energy in the future, because it takes a lot of time for copper mines to be operated, to be found and operated.
Thanks so much, Adeye Adegbusi, analyst, financial derivatives company, for sharing those insights with us. We do hope that Nigeria is able to bridge this gap in copper production, because we do have a lot of deficit in terms of housing deficits, and we've imported a lot of these materials. Maybe we'll start having our own, copper production industries in Nigeria, instead of having to import a lot of them. Thank you so much for joining us today. Now we'll move on to other stories, where the International Monetary Fund, IMF, has approved a disbursement of $80.77 million to help Burkina Faso address its balance of payment needs caused by the global food crisis. In a statement, the IMF says the emergency financing under the food shock window will help Burkina Faso mitigate the impact of the food shock on the most vulnerable. Food insecurity in Burkina Faso has increased significantly owing to deteriorating security conditions, which led to the displacement of about 2 million people, unfavorable climate events, supply chain disruptions following the COVID-19 pandemic, and Russia's war in Ukraine. As a result, about 16% of the population is in acute food insecurity conditions. The IMF adds that economic recovery in 2023 will depend on financing conditions, the security situation, and on efforts to mobilize domestic revenues to ensure priority public expenditure and public debt sustainability. Now, the African Development Bank, AFDB, has approved a grant of $28.49 million for Ghana to construct renewable energy infrastructure that will increase its renewable energy use by 10% through 2030. The financing, which will come from the Climate Investment Funds, will support the construction of mini-grids, standalone solar photovoltaic systems, and solar-based battery facilities for storing excess power. This is expected to contribute to closing gender gaps at the outcome level by creating 2,865 equitable jobs and livelihood opportunities, out of which 30% will be for women and youth. The FDB, under its New Deal on Energy for Africa, seeks to promote the reduction of greenhouse gas emissions on the continent. Now, Kenya and Germany have agreed to prioritize the elimination of non-tariff barriers to boost trade. The move seeks to reduce the cost of business and ease the movement of goods and services. Kenya's President William Ruto explains that the removal of the barriers will also enhance investments by German businesses in Kenya. He adds that this will also improve the balance of trade that is currently in favor of Germany. And that's it on Business Incorporated. Do join us tomorrow for another edition. I'm Will Ibong. Thanks for watching.